Good morning, everyone. My name is Jordan Levine. I'm a senior economist here at the California Association of Realtors, and thank you for joining us for our August 2018 housing market update. Being said, let's dive into the August numbers. How we're going to go through it is to basically talk about the mounting evidence for a market shift. We continue to see sales decline. They're down for 4 months in a row. We also have seen price growth start to slow down over the last 2 months. The other thing that we've seen that's more indicative of a market shift is the fact that the market's getting a little bit less competitive. We're seeing more discounting, some price reductions happening on behalf of sellers. And actually, before I get too far, can you guys let me know in the comments if you can hear me okay? Are we having any audio issues? Okay, great. Awesome. Thank you guys. Perfect. Yeah, and somebody asked actually where the handouts are. They're in the actual control panel. There's a section of your control panel called handouts. And if you click that little caret, then you'll be able to actually download the PowerPoint presentation. That actually reminds me that if you guys have any questions throughout, please list them in the questions panel and I'll try to address those in real time as they come up. Yeah, ultimately, these are all of the things that we're looking at that are showing us that the market has shifted, that we're in the midst of a market shift. But all that being said, I don't think it's time to panic yet. When you look at the main drivers for the housing market, it's largely the economy, and the economy is still doing pretty well. And I think that even in the midst of a market shift, what it means for realtors over the short run is that there's actually more listings coming online. So that's an opportunity for us as realtors to peel off some more business, potentially, boost our income and get some more market share. And so, although this might be a little bit worrisome, I think over the short run, at least, it gives us an opportunity to generate more business as individual realtors. And the other thing I would point out is that prices are still rising. And so that means that volume is projected to go up. Sales are down a little bit, but not a ton. And with prices increasing, it actually means that volume will go up and that there's more kind of potential income out there. You definitely haven't seen listing prices, which tend to be a really good leading indicator for what's going to happen with closed sale prices. Those have not tipped negative yet. And so again, that means more potential business for us. And so I think the moral of the story for me is that this year is going to be a pretty decent year, but what you don't want to do is just throw it in cruise control and expect by osmosis or something like that that we're going to get a bunch of new business just kind of dropped into our lap because the market is rising. It's still largely a market share game. And what that means is that there's, not enough sales to go around for all the realtors. And so what we need to do is actually get out there and hustle and carve out that market share. But to the extent that you can do that with volume increasing, it means that you could still have a pretty good year. And Michael asked, what is a negative listing price? I just mean growth in listing prices hasn't tipped negative. So when we look at closed sale prices, they're usually a function of what people are asking for their properties. And so until you see listing prices actually start to go down or growth in listing prices go negative, which is what I have in that bullet, that usually means that closed sale prices are going to follow suit in 4 to 6 months or something like that. So the fact that listing prices are still growing, are still higher than they were last year, suggests that closed prices are going to continue to go up this year. But we do see them slowing. So thanks for that question, Michael. As always, I want to get all the boring stuff out of the way. Steve asked if there's ever a time to panic. Yeah, I would say back in 2006-07 timeframe, it was pretty warranted to be panicking at that time. Thanks, Steve. But like I said, the biggest drivers of the housing market are the economy, the labor market, what's happening with unemployment. And if you look at those key statistics, the U.S. economy in California is still in pretty good shape. So we only have through the end of June, but the second quarter number for GDP, which is basically the main measure that we use to estimate the size of our economy, well, our economy was still growing. And in fact, it grew by one of the fastest paces that we've seen this cycle at 4.1%. That's actually even above the historical average, which is roughly 3% in any given quarter. It's still largely a consumer-driven economy. Consumption was up 3.8% last quarter, but we did see the business sector start to invest both in terms of new equipment and software, which is investments that expand their productive capacity, and also in non-residential or industrial real estate. And so that's actually a good sign. Consumers have been carrying a lot of the water for the economy over the last couple of years, and so it's good to finally see business start to come around. We have a little bit more broad-based growth, and we're on a bit of an even keel. Ernie asked, these are actually nationwide statistics. Ernie, we didn't get consumption stuff down at the state level, but the other thing I wanted to point out, though, which is kind of a negative, is on the inflation side. So we have seen inflation start to ramp up. In August, we had core inflation, which actually strips out those really volatile food and energy prices. And that's actually growing at about a 2.2% pace on an annual basis in July. It was actually a bit higher. I think it was 2.6 or 2.8. But be that as it may, we're slightly above the Fed's target range for inflation. And I think the reason why that matters for us as realtors is because it impacts interest rates. I think to the extent that we continue to see firming inflation, it's going to give the Fed the cover, or the kind of political cover, at least, to continue to normalize their interest rate policy, and that's going to impact short-term rates and eventually trickle through to longer-term rates. The good news is that unemployment at 3.9% in August is still at historic lows, and although we're basically at full employment, we continue to expand the labor markets, and job growth actually averaged about 1.6% last month. And so ultimately, again, the economy is probably our biggest strength at this particular point in time. More folks working, their companies are doing well from a profit standpoint, and they're hiring and paying more income. And I think those are all positives when we think about what's going on in the housing market. Arturo asked, how would government borrowing affect us? That's more of a longer term issue, but I do think that the government debt plays into interest rates to the extent that bondholders, aren't going to just stand by and let us overinflate the economy through deficit spending, and that's going to mean higher interest rates both at the short and long end of the yield curve. And so again, I think that the bond markets are going to demand their pound of flesh as these deficits mount, and that's something that I expect to happen more over the medium term. Thanks for that question, Arturo. So let's take a look at unemployment. Unemployment is actually at its lowest level in over 40 years. So in California, back in July, we won't get the August number until Friday. But if you look at where it was in July, we were down at 4.2%. And that's actually the lowest it's been going all the way back to 1976, which is basically the earliest that I can get consistent California unemployment rate data. It might even be the lowest in more than 40 years, but 40 years or 42 years is about as far back as I can go reliably. So the labor markets here in California are actually pretty strong. And what you can see over on the left-hand side here of this unemployment rate chart is that we had a much bigger crisis than the rest of the nation. So whereas the nation capped out at about 10% unemployment, here in California, we went up to about 12.5%. And if you look at where we are today, which is that far right-hand edge of these unemployment charts, what you can see is that we've effectively narrowed that gap to basically nothing. So although we had a much bigger unemployment crisis during the recession, we've actually done a much better job of chipping away at that overhang than most other parts of the nation. And in fact, when you look at the unemployment rate broken out by individual regions in California, which is what I'm showing you on the right-hand side, again, these are for July, but what you can see is that, yes, the San Francisco, Orange County, the South Bay, are all in the kind of sub 3% for unemployment. What you can see is that even in our more rural, kind of agricultural driven economies, that even there, where unemployment was in some cases up in the 20 to 25% range, like in Tulare, Merced, I think Fresno capped out around 20%. Even in those economies, we're down into the single digits for unemployment. I think that Sachin asked me what the unemployment rate is for Sacramento, and I don't have that number on my fingertips. It is here on this chart, but you just can't see it because all of the titles are compressed. But if you drop me a line after this, Sasha, and I can definitely get you that information. Thanks for that question. And if you look at where we are in terms of unemployment, we've blown way, way past those pre-recession peaks. And so right now, we're up at almost, a little bit over 17 million in terms of non-farm job growth. And so we continue to set new all-time highs for the amount of folks who are actually employed and earning money here in the Golden State. And so, that is one of the things that I think is again, still a relative feather in our cap. But if you look at the right-hand side, Shora asks where Kern County is, and actually, if I go back just a second, it's actually, I know that Kern is this second bar down here. So I think in July, Kern was at about 8.9% unemployment, I'm pretty sure. Thanks for that question. But going back to the job growth numbers, what you can see is that, yes, although we're at full employment, you would expect employment growth to slow, as I mentioned when we were looking at the U.S. numbers. The one thing you wouldn't expect, though, or that isn't explained just by reaching full employment, is the fact that the amount of job growth that we're seeing in California is no longer outpacing what we see in the rest of the U.S. by such a handy margin. So if you go back on this right-hand side chart and look at us, these red bars being California from basically 2012 all the way through to mid-2016, what you can see is that we were handily outpacing the rest of the nation in terms of job growth. We were in the 3 to 3.5% range for job growth, whereas the nation was about 2%. The nation's still about 2%, 1.6%, but what you see lately is that California's economy has started to converge with growth in the rest of the United States. And that's something I think that you can't explain simply by pointing the fact that we're at full employment. I think that, that's true everywhere. And the fact that California is no longer able to outperform the rest of the nation, I think is something that's pretty directly related to what's going on in the housing market. So we have, very lackluster affordability. We have a lot of out-migration to other states, which we'll talk about a little bit later. But I think that's really hindering the economy's ability to continue to outperform the rest of the nation. It's just simply too expensive. And a lot of workers, millennials, and folks all the way up actually to the age of about 45 are largely responsible for that out-migration that we're seeing. And unfortunately, in contrast to, the late 1990s, if you wanted a high-skilled job in the tech sector or something like that, you pretty much only had one option, and that was to live and work in the Silicon Valley. But you fast forward to 2018, and there's a lot more game in town for those jobs. The demand for labor for these high-skilled workers isn't just centered and concentrated in the Silicon Valley. Yes, that's still, what I would call the kind of home of the tech sector. But that being said, you've got a lot of other options if you're a graduate coming out of university or an experienced worker working in one of these industries where, you can go to Denver, you can go to Boston, Seattle, some of these other places where, housing affordability isn't as tight as it is here in California. And for a lot of folks, that means an improvement in their quality of life. And so, this is something I think that isn't anything that you want to panic about, but rather I think it's a trend that is indicative of just how this housing challenge and this affordability crisis is really starting to impact more than just us as realtors, right? This is really starting to take a bite out of our overall economy because we're just not able to continue to outperform with prices as unaffordable as they are today. The good news is that every sector is still growing, but they're just growing by a smaller pace. So if you look at July's numbers, every single sector outside of natural resources and mining, which is largely our oil industry, and we know that oil prices are all over the map, continue to grow, but they're growing by a little bit lower of a percentage than they were basically this time last year. And I think, look at construction as a prime example of that. Last year, we were growing construction jobs by, 5.5 to 7%. Now that's dwindled to about 1.3%. And when you look at it on the right-hand side, on a kind of month-over-month basis, you can see that, yes, we are continuing to to add jobs. But again, a lot of those sectors are now in those kind of low single digits, like real estate, like education and healthcare, like construction and tourism. These were all sectors that were performing much better, and which is why we had, that 2.5 to 3% job growth last year, and why it's dwindled to just 2% or so this year. And again, this is a housing issue, right? We can't continue to grow our economy when we're sending workers over state lines into places like, Nevada and Arizona and Colorado and Texas and Washington, and to a lesser extent, Oregon. And actually, this is kind of a really interesting chart. So what I've done here in yellow is I've actually highlighted what I would call California's quote unquote core job centers, right? Los Angeles, Orange County, San Diego, the East Bay, San Francisco, and the South Bay. And what you can see on this chart, which is non-farm employment growth by each metro in California, what you see is that a lot of these markets, these secondary and tertiary markets outside of our core employment centers, were much later to the game in terms of recovering from the Great Recession. But actually, over the last year or so, we've seen a lot of the job growth shift into some of these more affordable markets that, were, again, harder hit by the downturn, slower out of the gate during the recovery. Whereas, the core employment centers really got off to a hot start and really lifted us out of that Great Recession. But now, as these markets become increasingly unaffordable, you have a lot of what I call the California two-step, right? Where you have a lot of folks migrating from these kind of core employment centers that have become unaffordable at a faster clip than most other parts of the state, going out to places like the Inland Empire, which was our second fastest growing economy in the nation last year, to places like Stanislaus or, places outside of the core Bay Area. It's only the South Bay out of those core employment centers that continues to kind of outpace the rest of the state in terms of job growth. But for the most part, a lot of our employment growth is actually transitioning to some of our, more affordable markets. And the second half of the two-step is that people who used to live in places like, Chico or Monterey or Stanislaus or the Inland Empire are actually getting priced out of the market by some of these folks coming across from, places like Los Angeles, Orange County, or Alameda County up in the Bay Area into Stanislaus. They go out to these secondary markets and push prices up to the point where existing residents in places like the Inland Empire, Stanislaus, Solano counties, San Joaquin, all those places that are just outside or on the edge adjacent to these core employment centers are being priced out. And that's largely where this out-migration to other states is coming from. So you have folks shuffling from the core to these secondary adjacent markets, and folks who used to live in those adjacent markets are being priced out by these higher income earners pouring over the county line, and in fact are getting pushed out to places like Nevada, Arizona, Texas, Oregon, Colorado. And of course, rates are rising, but they have held steady at about 4.5% over the last couple of years. And you can see that that's about a 75, 80 basis point increase from where we were just prior to the presidential election, right? We were down at around 3.6, 3.7% or so, and they've jumped about 80 basis points this year. That's a pretty significant increase, and it's something that, has taken folks some adjusting to and pretty much takes a big bite out of incomes. But I do think that it's important to keep perspective on interest rates. I think when you look at the actual level of interest rates, I always joke that my dad used to drag me around to his dinner parties in the 1980s and brag about his 12% interest rate back when interest rates were, almost 16%. So that was a real feather in the cap for him and gave him some real bragging rights. And so from that perspective, a 4.5% interest rate for a 30-year fixed rate mortgage isn't going to be an absolute killer in terms of just the absolute level of interest rates for housing out there. That being said, though, the increase in interest rates, again, does take a big bite out of what folks can afford. So although I don't think this is Armageddon, it is something that's going to impact pocketbooks of our buyers out there, and that's something to keep in mind. So what I'm showing you here is what happens when interest rates increase, even at the median priced home. So this is as of the second quarter, when the median price in California was just under 600,000 or so. And you can see that if you go back to the pre-election interest rate of about 3.5%, that median priced home costs roughly $2,100 a month, including interest and property taxes and all that good stuff. If you go up to 5.5%, where some folks think we're going to go, 5.5%, you can see that that payment on the exact same $600-ish thousand median priced home goes from $2,100 all the way up to $2,700, right? And so that's about a $600 a month increase, or $7,200 a year in post-tax income that you need to actually pay for the exact same house, right? And so $600 a month, that's not going to getting you, a nicer kitchen or an extra bedroom or bathroom or more square footage. This is all just purely the finance cost, the interest costs associated with that exact same priced home, given that interest rates are going up. Now, we're fairly, I think, conservative on the pace of interest rate increases. So we think we're going to end up next year right around 5% or so. We don't have us going up as high as some of these other folks who are out there forecasting. But even still, you can see what a pocketbook issue it is for interest rates. So although, by my dad's standards, 4.5% mortgage rates are still pretty low, you can see that what 4.5% or 5% interest rates does in terms of how much money you need to bring to the table or be able to show your mortgage lender that you're able to carry. And this red chart over here on the right hand side is the exact same kind of thought experiment expressed in a different way, right? It's the minimum income you need to qualify for that $600,000-ish median priced home. And at 3.5%, you needed about $113,000 in income to qualify, and that's total household income. Now, if you go up to 5.5%, where some folks think we're going, that adjusts up to about $135,000. And so that's about a $22,000 a year increase in terms of household income. And I know that most realtors are working on splits, but I can assure you as a salaried worker that when you go into your boss's office and say, hey, I need a $20,000 a year raise because interest rates went up, the conversations don't tend to last very long. And so this is going to be pretty difficult for folks who are pretty much already up against it from an affordability standpoint. Now, I got a question from Juanita that says in some areas in SoCal, we're seeing an increase in Chinese and other Asian buyers making all cash purchases. Is this a correct understanding of why housing prices are going up in the Inland Empire? I think that's part of it, Juanita. I definitely think that investors, given our limited amount of supply, have contributed to the decline in affordability. We just don't have enough housing supply, full stop. And so when you get additional buying activity coming from the investor community and in general, and the foreign investor community specifically, it does eat into that kind of limited amount of housing supply. That being said, the percentage of foreign buyers in our market has actually dwindled. So I think we were up at about 8 or 9% a few years ago. And since that's dropped to about 3 or 4%. So there's actually fewer active foreign investors in California today than there has been over the course of the last couple of years. So I don't think that's the overarching thing, Juanita. I think that the fact that prices are going up are twofold. One, we don't have enough housing, even in places like the Inland Empire. That's true both in terms of existing housing not turning over, but also just not building enough. And the fact that you're getting this kind of bump in demand in places like the Inland Empire, like Stanislaus, Solano, San Joaquin counties outside of the Bay Area, because folks can't afford to live in those core places where they actually work. And so they go out into these markets. And so you have kind of a twofold problem where there's not enough supply and a bunch of additional demand in some of these more affordable markets. I think, Will points out that investors can also get better returns by putting your money in real estate than putting it in a bank. And I definitely think that gets some of those folks into the real estate market, but I think the stock market's also been doing pretty well. I think it might be a little bit frothy at the moment. The stock market might even be more overvalued than the housing market, which is why I think some investors are turning back to housing. But be that as it may, the main takeaway that I wanted you guys to pull from this chart is that yes, my dad's interest rate was much higher, and he would still be rolling over in his grave to be able to get a chance at these 4.5% mortgage rates. But I think that the days of 3.5% rates are behind us, and B, even a small jump from 3.5 to 4.5 or 5% does take a big bite out of people's paychecks in terms of how much money they need to buy the exact same home. So unfortunately, I said the economy is kind of the bright spot right now, but the housing market isn't doing as well. And when you look at transactions, we actually had our biggest drop in several months, and unfortunately, we finally dipped down below that critical $400,000 or 400,000 unit benchmark for existing home sales in August. I think that's the first time we've been under 400,000 in about 2 or 3 years, and we also have the biggest decline in existing home sales that we've seen in over a year as well. And so, I think that unfortunately, this good job growth, this good income growth, the fact that unemployment is at its lowest level in over 40 years hasn't translated through to this big sea change of new transactions on the residential side of the market. And unfortunately, when you look at this chart, it's actually somewhat depressing, because if you squint at it, you can see that these teal bars that represent 2017 were up slightly from where they were in 2016. But for all intents and purposes, home sales in California have basically been flat going all the way back to 2008, 2009 timeframe. So all of this, new all-time highs and jobs, the fact that incomes are growing and things like that haven't really translated into a bunch of additional home sales. And again, this is something that I lay squarely on the shoulders of housing supply. And we're going to talk about that a lot more in the next couple of minutes. Erica asked, how much longer do we think the effects of the fires in Napa and Sonoma counties are going to be felt from October 2017? I think that, unfortunately, a lot of the housing stock, especially in Sonoma, got wiped out, and we're already in the midst of a supply crisis. And if you look at places like the Ventura County market, where they had fires, before the fires out in Napa and Sonoma, they're just now starting to see some signs of recovery out there. And so I think that you can expect to feel the effects linger, even throughout the rest of the year and into 2019. Pete asks, what about lower capital tax deductions in California? I do think that's playing a role, especially with the cap on state and local tax deductions. So you can only deduct $10,000 worth of income and property taxes, which really affects the top end of the market. Unfortunately, Peter, if you look at the statistics, which I'll walk you through here in a second, the top end of the market, where you would expect those effects to be greatest, right? Because those are the folks paying the most income tax with the highest property taxes, and are, by definition, going to see their deductions reduced by the most, given this imposition of a $10,000 cap on how much of those taxes you can deduct now. That end of the market, where you'd expect to see the greatest effects, is actually the only part of the market that's still growing. And so although I do think that there is some impacts of tax reform, specifically on the limiting of deductions, it hasn't really upended the top end of the market. Now, at the bottom end of the market, I do think you're seeing some of the impacts of a lost home ownership incentive, right? We've doubled the standard deduction now, and so folks are able to deduct $24,000 if you're a married couple off of your taxes, regardless of whether you rent or own. And I do think that's given some buyers at the bottom end of the market some pause about getting in. Why am I going to absorb this additional cost and take this additional risk if I don't get this kind of tax benefit for doing so, right? That helps me offset these other kind of risks that I'm taking. And so Betsy asked, wouldn't folks at the high end of the market get more of a tax break due to their incomes, and so they don't care about getting a tax break on their homes? That's partially true. So it isn't just a one-for-one reduction in those deductions. We also saw those same folks get their overall tax rates lowered. And so there is somewhat of an offsetting force there, in terms of, you get actually more tax money back just in general on your tax rates. That being said, some of these folks at the very high end were in some cases deducting $50, $60, $70,000 a year or more off their income tax, and so they will still lose a little bit of money. Whether it's enough to kind of kick them out of the housing market, I don't think so. I think there's a lot more involved in what goes into a housing decision than just purely what your tax bill looks like. That being said, at the margins, I do think you're seeing a bit of an impact. So Hiram asks if I see a January '07 to September 2007 decline happening in the coming months. The short answer to that, Hiram, is no. I think that, and I'll walk you through some of the reasons why here in a minute, but ultimately, A, the market's not as overvalued as it was, and B, the economy is still going strong, and so we don't have all those crazy option arm, or you guys remember the ninja loans, right? The no income, no job or asset type of loans. Those haven't been very prevalent this time around. Most folks have a 720 FICO score or more who have gotten into the market during this cycle. You have some, at least some skin in the game, right? Even folks who came in with an FHA loan or some other kind of low down payment loan have at least 3% in terms of a down payment. So they do have some skin in the game. And of course, their prices are still going up, right? You don't walk away and foreclose on a house that's worth more than you bought it for. You simply sell it. And so Chris asked, do I see any trends for days on market? Yep, Chris, I'll get to those in a minute when we talk about the competitiveness. Jessica asks if I see prices going down in saturated areas. I think that's definitely a possibility, but it's not something I see happening over the next, 4 to 6 months at least, right? And I'll talk about a little bit about why, but basically, what you see is that list prices are still going up. That means that closed sale prices will still go up. We expect them to go up at a bit of a slower pace, but we do expect them to continue going up through the end of the year. So this is kind of a map of where the transactions in California happen. You can see that 46% of all closed sales happened in Southern California. Another 23% happened in the Central Valley. About 1 in 5 happened in the Bay Area. The Central Coast is about 4%, and everywhere else, which includes basically the far north and our mountain regions adjacent to Nevada, are about 8%. Unfortunately, when you look at how those markets are doing, every single area in California had a decline in closed sales last month. So Southern California led the pack. We were down by basically 8%, 5.5% decline in the Central Valley, which had been continuing to do pretty well given that it's relatively more affordable than the coastal areas, and the Bay Area, which had been able to kind of shake off some of its affordability problems and really lean on its strong economy. Even there, we've seen some bumps in the road. These are actually year over year growth rates, Ernie. Thanks for that. Other counties in California were down about 5%. It was only the Central Coast, where I call home, which were relatively flat, but even there, we saw a bit of a modest decline in home sales. And so, unfortunately, the big players, Southern California, Central Valley, and the Bay Area, where, basically 4 out of 5 home sales take place, or even more, about 4.5 out of 5, all of those major markets actually saw a pretty substantial decline in home sales last month. And of course, when you break it up by price range, what you can see is that it's really, again, a phenomenon down at the bottom end of the market. Homes priced under $300,000, which are, mostly in the Central Valley, some in the Inland Empire, not a lot. But even all the way up to $750,000 are declining. And again, these are year over year growth rates by price segment, and actually the top end of the market, which kind of gets back to Betsy's question, where prices are $1 million or more. Those market segments are still growing by a pretty healthy clip, right? And so this is in spite of the fact that listings have really started to come back and are actually stronger at the bottom end of the market. And this is why I see a demand side issue bubbling up under the surface, right? And we'll get to the supply stuff later. Maybe I should have probably brought it forward now. But be that as it may, we're seeing more supply coming online, especially in the sub $750,000 price point. And yet, despite all of these new listings, we're still not growing in sales, right? And so that, again, is indicative of a supply or of a demand side issue, right? Because if it was just supply, holding the market back, what you would see is that as these active listings in the sub $750,000 price range come online, they would have just been snapped up just like that, right? And the fact that they aren't suggests that there is some either trepidation on the part of buyers who maybe think that the market might be peaking or cautious. We kind of jokingly call that the psychological scar tissue that's left over from people who maybe bought in 2005, 6 last time, and in many cases were left holding the bag, are worried about the same thing happening again. Or, and I think probably a bigger part of it is just the pure erosion in affordability. Many people just simply cannot afford at today's prices, combined with that, 80 basis point jump in interest rates, to be able to jump into home ownership. So Doug asks if this is normalized for sale price growth. So if prices are increasing, then you'd expect to see the low end dropping. That's true, but we look at this on a quintile by quintile basis as well, Doug, where we just let the kind of bottom 20% be at whatever price point the bottom 20% is, and you see basically the exact same trend there. And there actually is, I know not along the coast, but there is we used to break this up into under 200 and then 200 to 300. That's one of the reasons, Doug, why I went ahead and just combined these all into a sub $300,000 price point, because we really just don't have any more $200,000 homes, but a lot of those homes did graduate into the $200,000 to $300,000 category. Yes, these are August sales compared on a year over year basis. Miguel, thanks for that question as well. Appreciate it. This is in units. So Michael asks if this existing home sales growth is in terms of units or dollars. These are the number of transactions, right? And so that's why I said, again, you can still do fairly well from an income standpoint, because although sales aren't growing in terms of transactions, we are actually seeing increases in prices on these fewer number of transactions, which means that overall volume is going up, but it's not going up because we're turning over all these new home sales. So how about prices? What we've seen there is that, yes, prices are still basically near an all-time high. We broached 600,000 a few months ago, and now they've had a seasonal dip because the summer buying season is basically coming to a close. But we're still at basically $596,000, which is right near that all-time high. But the interesting thing here is that we've seen price growth slow to about 5.5%. So I think for the first 5 or 6 months of the year, we were growing by 7-8% consistently on a year over year basis. So every month, the median price was about 7-8% higher than it was at the same point a year ago. And what we've seen over the last 2 months in July and August is that price growth has actually dipped into the kind of low to mid single digits. I think last month it was about 4.5% or so, and this month it's 5.5%. And so again, nothing to panic about, right? We'll take 5.5% increases as existing homeowners. That's a 5.5% increase in my home equity from where it was, a year ago. But at the same time, it does show that prices are slowing down. And I think, again, indicative a bit of a demand side issue where, not that we don't have any demand, but just that we have less demand than we had before. In fact, if you checked out our press release, I think the metaphor we used is that, it looks more like a market where we're kind of taking our foot off the accelerator a little bit rather than a market where we're taking our foot and slamming on the brakes, right? And I think that's probably as good of an analogy as you're going to get an economist to come up with at 9:30 in the morning. And again, list prices haven't dipped negative. So if you look at this red line, this is actually list price growth. So how much higher list prices are today from when they were a year ago. And what you can see is that the list price growth usually leads the closed sale prices by somewhere between 4 to 6 months. So if you see a big spike like we did in 2009 in list prices, in early 2010, that actually translated into a big bump in closed sale prices. And so what you can see is that, again, we're hovering in that kind of 5.5% range for closed sale prices here at the tail end of this chart. But what we've seen is that the list price growth has actually been trending down. So we're still at about 3.5%, but it is trending downward pretty consistently. And so ultimately what this leads me to believe is that we're going to continue to see this kind of slowing of price growth through the end of the year. But this also goes back, I think, to somebody's question from earlier on, where they were asking, do we see an '07? I think it was Hiram who asked earlier, do we see a 2007 type dip in the coming months? And the reason why I said no is that listing prices are still going up. So sellers still haven't kind of reconciled with where buyers are at or with where affordability is at, and continue to ask for more than they would have asked for at the same point last year, but just by a smaller margin. And so again, I don't think there's any impending doom here, but I do think that we can expect to see the growth in median sales prices continue to slow, because buyers just simply aren't, or sellers rather, sorry, aren't simply upping the ante at the same pace as they were a year ago. That being said, if you look at the top end of the market, we have seen that same kind of downward trend, but for $1 million plus homes, the growth in listing prices is actually going down, right? So they're asking about 4.5% less for those $1 million plus homes in August than they were at the same point last year. And so I do think that, again, is indicative of a market that could start to cool in terms of closed sale prices, right? So folks want to get in at the high end. It's still a relatively good bet. You get more than you get just by kind of sticking it in a 10-year bond or something like that. But I think the growth at that end of the market is going to continue to see some slowing from the double digits where it's been most of this year. Thomas asks, some places in the Inland Empire are still 20 to 30% below 2006 levels. I think that, in general, the slowing is coming from the demand side of the equation. And so even though I do think that over the long term, Thomas, there's a lot of headroom in places like the Inland Empire for more growth, ultimately, if demand starts to taper off a little bit, then that will translate into closed sale prices, even though, again, they have a little bit more room to run. Thanks for that question. And what about the signs of a shift? So, ultimately, if you look at where the prices are growing the most, and I think this gets back to Doug's question. So instead of looking at it on a price point basis, we broke the market up into percentiles, which is a really nerdy econ thing to do. But basically, we let the cheapest 20% of homes, regardless of what that price point is, stand as its own category. And then the next 20 to 40% of homes all the way up to the 80th to 100th percentile, which is that kind of top 20% most expensive homes in the market. What you can see is pretty much the exact opposite of what we saw last year. So, last year, the bottom end of the market, which was the tightest and still actually was having the most price growth, right? And that's totally indicative of excess demand butting up against too few active listings, or, too scant of supply to really push prices up the most at that bottom end of the market, which was the most competitive, the most excess demand, and the lowest amount of inventory. And you fast forward to August of this year, what you can see is that the cheapest homes, right, that lowest 40% of homes, are actually growing slower in terms of price than the top end of the market, right? And so again, this suggests that there is some kind of a demand side issue, because again, supply is still relatively tight down at the bottom end of the market. And so if we had all this excess demand and lots of multiple offer type scenarios and bidding wars breaking out all over the place, you would expect that segment of the market to be growing the fastest in terms of price. And so I think that the fact that that isn't happening does suggest that there is some demand side component to this. Whereas, at the top end of the market, where there does seem to be a decent amount of demand still out there, that, and there's a lot more supply. I think we're up in the 7, 8, 9%, 9 months rather of supply at these top end price categories. They're actually seeing the most price growth, right? And so again, this tells me that there is a shift in the market afoot. Eric Tan asked, how does days on market play into all of this analysis? Well, that gives me the perfect segue into this chart. And what you can see is that actually the median time on market is starting to increase as well. So in August, we were at 20 days. That was the median time on market, which is, again, by historical standards, still very, very quick turnaround times for a residential home. That being said, it's higher than what we've seen, actually in the last couple of years. It's up from 18 days, I think, last month, and I think we even had 18 days in August of 2017. And actually, median time on market is going up, I think, for 3 or 4 months pretty consistently. And so again, this is, suggestive of this abatement of demand. Not that demand has disappeared, but that it's gotten a bit less because, again, if it was just a supply constraint holding us back, then what you'd see is that these new listings come online and they fly right off the shelves in very short order. And so the fact that they're sitting around a bit longer suggests that, buyers are holding off, they're dragging their feet, what have you. And you can see that this is pretty consistent across the market. So I'm showing you this time on market compared to last year by quintile, by those same price categories. And what you can see is that the biggest jumps are, again, at the bottom end of the market, which is the most inventory constrained, right? I think we went from about 16 days or so to 19 and 21 days, respectively, for those cheapest 40% of homes out there. And in fact, in the 96th to 100th percentile, so I further subdivided out the top 20% to get very granular at the top end, you can see that actually days on market for that top 5% most expensive homes is actually down from about 28 days to 25 days. And so again, if it was just an inventory issue, the inventory is tightest at the bottom end of the market, you would expect the time on market to be going down. That it isn't suggests, again, that buyers are being a bit more reluctant. We haven't seen a ton in the way of discounting, right? We have a sales to list price ratio that's basically still at 100, but we are starting to see some baby signs of a discount. Will asks how many days or months of supply do we have at the lower price levels? I'll get to that in just one sec, Will. Thank you. And Doug asks, how granular can we get this quintile data? Yes, I do have this at the regional level or at the county level. If you send me an email, for brevity's sake, because we have folks from all over the state, I didn't bring all the county level stuff with me. But if you drop me a line, and you'll see my email at the end of this webinar, I can break out whatever counties you want to look at, Doug. Thanks for that question. Moving on, what you can see though is that even though these kind of closed sale prices are still basically right at asking price, what you can see is that prior to closing sale, these red bars, which are too skinny, I need to figure out how to beef these guys up a little bit, but ultimately almost 40% of active listings have been reduced, and that's something that's gone up for 7 months in a row. There's more active listings being discounted today before they even get into a kind of closed sale or into a transaction into escrow, which is what that previous chart was showing you. That's something that has been ramping up. And so although buyers are still basically paying exactly what sellers are asking for, that's after sellers have actually had to reduce their price to get some bites on those properties. Okay, again, so if you look at the green line here, which represents the typical discount for those 40% that are reducing their price at some point during the active phase, you can see that the discounts are still relatively small, only about a 4.3% average discount. But again, that's something that's been growing for the past 6 or 7 months on a year-over-year basis as well. We're still nowhere near the 2010-11 timeframe when we were cutting prices by 9-10% on active listings. That's still 4.3% is still relatively small. Tracy points out that it looks seasonal, and I would agree on the 4.3%. It is you do tend to see more discounting in the fall and winter months than you do during the summer. But that's why I do these year-over-year comparisons, Tracy, so that we're comparing August to last August when that same kind of seasonal influence was still in play. And that's why I say that at 40%, we've seen, that number increase even on a year-over-year basis. So baking in those same seasonal trends into the actual data, that's been going up for 7 months in a row, which suggests that there's something more than just a typical seasonal pattern. In fact, at 39.9%, I think we have more active listings that have had a price reduction in August than we have since, I think it was about April or May of 2014. So this is something that's at a higher level than it's been in about the last 4 years, which is why I think it's real. And of course, inventory is the biggest swing item. So we're seeing inventory rise from about 2.9 months of supply where we were last August to about 3.3 months of supply. Now, again, by historical standards, that's still a very low level of inventory. But look at active listings, right? We had about 35 or 36 months in a row of declines in active listings, which is what I'm showing you on the right-hand side. This is the year-over-year percentage change in the number of actives out there on all the MLSs combined. And what you can see is that every single month of 2017, we had at least a 10% reduction in the number of active listings on the market. Now, fast forward to 2018, you can see that that pace of decline really slowed in January, February, and in March, it finally turned positive and has continued to trend upward. In fact, in August, we had the biggest increase in the number of active listings on the market that we've had in many years. 17.2% jump in the number of active listings out there. And so again, if supply was the only barrier holding us back, you would have thought that we would have seen this kind of 6-month or 5-month in a row growth in active listings, really just unleashing this whole new wave of transactions and being enough to kind of boost sales in aggregate in California. And so the fact that even with a 17.2% jump in the number of homes actually available for sale, that still hasn't translated into growth in transactions. That's got to be at least partially a demand side issue. And if you look at the comparison, you can see that those margins were relatively small, right? So comparing the number of active listings in April of this year to April of 2017, it was a pretty modest amount of additional active listings. In May, it got a little bit bigger. In June, that gap opened up even wider. And in July and August, you can really notice the fact that active listings are much higher than they were at the exact same time last year. Chris asked, to what degree is this increase in active listings attributed to panicked sellers who have option arms that might be about to reset and see their payments increase? I think, for me, Chris, that's probably not the major driver of this. Honestly, when you look at the mortgage originations from the GSEs or like the Ellie Mae origination reports and things like that, the vast majority of mortgages that have been originated over the course of this cycle have been 30-year fixed rate mortgages. And so I don't, to me, see that kind of ticking time bomb element that we had back in 2005-06, where yes, you did have a lot of people in 5/1 arms. They were accumulating lots of negative amortization every month by not meeting that full interest payment. And, they said, oh, you've got 5 or 6 years and you can always just refi at that time. And lo and behold, a year or two down the road, your loan kind of resets and you see your payments maybe double overnight. That gave folks a lot of strategic reasons to default or foreclose on those homes because they were making the calculation that, look, my credit score is probably going to recover faster than my home price, and so I'm going to go ahead and walk away. We don't have that this time because so much of the majority of folks actually got into fixed rate mortgages this time around, had documentation of their incomes, had some skin in the game, had at least a 720 FICO score. And so although this may be partially influenced by people getting rid of their option arms, I don't think that's the major driver. I think that what we're seeing is a shift where folks are maybe thinking about the market might be peaking, wanting to get out ahead of it. I think that with this Prop 10 looming, that you're also seeing some investors start to dump some of their units, especially on the single family side, because they don't want those investments to be potentially impacted by rent control ordinances that might go through after the November election, and have seen quite a bit of appreciation on a lot of those units that they may have bought back in 2009-10 and are thinking this might be a good time to actually get out of the market. So what about growth? Where is the growth happening? And I think for me, this is the biggest indicator that there is a market shift happening, because again, when you look at where that 17% jump came from, a big jump was at the sub $750,000 price category. And so again, as you can see over here on the right hand side, under 300,000, under 750,000, even under $1 million are basically, right around 3 months of supply. That's the tightest segments of the market. And so, up until 2018, really, I would say that supply was the main contributing factor holding back transactions. But now what you see is that the active listings are growing by twice as much at the bottom end of the market as they are at the top end of the market. And yet, despite that, we're seeing this decline in sales. And so again, if it was just supply, these 7-8% increase in these active listings for $300,000 to $500,000 and $750,000 homes would have just been snapped up just like that. And the fact that they're continuing to linger and actually staying on the market even longer, and actually seeing some of those sellers start to reduce the prices on those active listings, is suggestive of the fact that there's something going on with buyers where they're either unable or unwilling to jump into the market at this particular point in time, which is why you see that on the unsold inventory index on the right-hand side here, you can see that basically every category under $1 million had decent jumps in the months of supply on the market right now, is because A, listings are going up, and B, sales are still going down. And that actually translates into more months of supply out there. Lillian asks, how would you contribute Californians just wanting out of California because of politics, high costs, etc., affecting the market? I do think that a lot of folks are leaving California, but I think that the pocketbook issues, Lillian, can't be overstated. The cost of housing, I think, is a significant portion of that, because that's our single largest expenditure that we make. And so even if you have a great job with a good income, with where housing costs are today, that doesn't always translate into a great quality of life. I think when you look at where folks are going, they're going to places not necessarily with booming economies. They're going to places where the cost of housing is that kind of similar thread that carries through all these markets like Nevada, Arizona, and Texas, where a lot of our, I think it's something like 6 or 7 in 10 of our out migrants go to one of those 3 states. Those aren't states where, yes, I think that they're viewed as having a better political climate, or a more of a kind of don't tread on me type of political climate, if you will. But the thing that I think that really matters is that they're much more affordable to live there. I mean, you can go to Texas and take a 20% pay cut from what you're making in San Francisco, but because houses cost, a third of the price, you're still coming up in, with a much better quality of life, even taking a modest pay cut. And I think that this is a really telling chart, right, where we can't say that it's just supply anymore. So what I'm showing you is the growth in active listings by price segment compared to the growth in closed sales last month. And so what you see is that the biggest increases in supply are at the bottom end of the market, and that's where the biggest declines in home sales actually are. Now, at the top end of the market, where you have like little amounts of growth in active listings, you're still getting growth in closed sales. And so that's why you're actually seeing unsold inventory actually decline at the top end of the market. But again, this is definitely pointing to a demand side problem. You can see supply at the bottom end is up, and yet sales are down, right? So what are the consequences? I think that Ernie asked what percentage of folks leaving California go to Arizona, Nevada, and Texas. And I don't have the exact percentage on me right now, Ernie. I can get it for you if you email me, but I think it's something like 65 to 70%. I think it's 7 out of 10 out migrants go to one of those 3 states. So now's the portion where I get up on the soapbox just really quick and point out what this all means and why it matters for us. And what you can see is our housing affordability index, which is this green line here, compared to the yellow line, which is the nationwide housing affordability index, has really dropped down to 26%. What that means is that 26% of Californians can actually afford the median priced home at this particular point in time. What it also means by definition is that almost 75% of California's households cannot afford the median priced home. And that's, much, much worse than what we see in the rest of the U.S., where over half of folks still can't afford that median priced home. And so this presents a real barrier to growing home ownership, but even more than that, to growing our economy, right? And I showed you those job growth numbers way back at the beginning. And what you can see is that, as it becomes more unaffordable to live here, that some of those workers start looking farther afield for places where they can still achieve that dream of home ownership, which we know is still consistent. In our survey research, people still want to be homeowners. They still associate home ownership with the American dream, and they're not able to make that dream happen in California, and so they go to other places. So this is a problem for us as realtors, right? That's fewer transactions, but it's going to be a much bigger problem even for our economy just in general, and the businesses who want to recruit and lure workers here, but can't possibly pay them enough to give them that same quality of life that they might get in Austin, Texas. And if you look, only 2 counties, Lassen County, actually only one. Lassen County is the only county in California that has better housing affordability than the rest of the nation. Even in Kern County, it's basically the exact same as what you could afford to spend in other parts of the nation. Outside of that, all other 56 counties, even in Tehama County, right, where there's not a lot of jobs, isn't a huge employment center, it's even less affordable to live in Tehama County than it is to live in virtually every other part of the nation. And if you look at the right-hand side of this chart, you can see how scary things really are getting, where, you know, upwards of 85 to 90% of folks cannot afford that median priced home. And so again, as realtors, that's problematic because we're not going to have any buyers left over. But as an economy, it's increasingly challenging, right? I've got this great tech company and I want to pay this new graduate $100,000, $120,000 a year, but they're facing maybe $1.5, $1.6 million home prices. They've still got to get 4 or 5 roommates to make that dream a reality, even when they're a 22-year-old making 120 grand a year. And that's going to be an economic problem coming down the road. Of course, you know, I'm not going to belabor this, but last webinar, someone did point out that we didn't say anything about homelessness. We did say something about homelessness. And in fact, California has the largest chunk of the homeless population, much more than in New York or Oregon or even Nevada, where it's warmer, or Texas, where there isn't as much, cold weather issues. California is bearing the brunt of this housing affordability, both in terms of folks not being able to afford housing, in terms of ownership housing, but B, just finding themselves relegated to living on the streets. And this is a huge problem socially, economically, and really is just kind of another indicator of how bad this affordability crisis has really gotten. And this is really the most telling is if you look at outmigration since 2010, we've lost almost 1 million residents on net. Right, so that's even after taking into account the people who migrated into California. Yes, the percentages, sorry, going back, Hiram asked if those percentages on the Housing Affordability Index were based on the local prices. Yes, they are. So we take each area's price and the amount of income that folks earn there and do that calculation on a county by county basis using the county incomes and the county home prices. Thank you for that question, Hiram. So yeah, when you look at net migration, again, so even after accounting for all of the people who moved into California and subtracting those off, we've still lost almost 750,000 people over the last 7 or so years. And in fact, since 2015, we've consistently lost over 100,000 people per year. And so these are folks who are, and I didn't bring these stats with me today, but we do have them. And if you look at who these folks are, these aren't the kind of really high income earners who are oppressed by California's, income tax regime or anything like that. These are our solidly middle class workers. They're millennials up to about 45 years of age, and the vast majority make under $100,000 a year. So these aren't the folks who are paying these kind of egregious income tax rates. These are folks who are trying to, stay in the middle class and attain that dream of home ownership, not able to do it because prices have gone so high, and in fact are seeking greener pastures. Kafir asks, what's the sentiment on the probability of Prop 10 passing? Well, I would urge you to not rest on your laurels there. I think that there's a decent probability. I think California is really good at attacking symptoms and not causes. And while I'm of the opinion that, rent control is totally attacking the symptom of our lack of housing supply and trying to put a price cap on rents, it does nothing to boost the amount of supply, which is the real fundamental thing causing affordability to have deteriorated so much. And in fact, it's going to make it worse over the long run, but that's a more academic argument. And I think that, when people have experienced significant increases in the amount of rent they're paying and they have an opportunity to put a cap on that, they don't tend to do a lot of economic or, advanced academic analysis and say, hey, that sounds good. Prices are too high. Let's put a cap on prices. And so I would urge you to get out there and work the contacts in your network to make sure that people know really what's at stake, because I think that there's a real risk of it reducing the amount of lackluster building that we're already doing even further and causing affordability to erode even more. Mo asks if I can define what the window price ranges of mid to the high range. I think it depends on county by county. That's why I tend to do those quintiles, Mo's, because $750,000 is a lot of money in most parts of the state. But if you go up to places like San Francisco or Santa Clara, I don't even think they have any housing inventory below 750,000. So really depends on what market you're in. And Roshan asks, with interest rates only rising from here on out, what relief will there be for affordability? Unfortunately, I'm not optimistic about which way affordability goes. I don't see a big sea change in terms of how much we're building, Roshan. And unfortunately, we're still a strong economy that's generating jobs. And that means that we're going to continue to have too much demand and not enough supply. And with rates continuing to go up, I think that, if you look at where our forecast is, and I'll get to that in just one second, we're forecasting that affordability is going to continue to decline and actually drop below that 25% threshold. The other thing is it increases our vulnerability, right? If you look at this two measures of what I would call fundamentals on home prices, what you can see is that the median priced home in California is now 8 times greater than what the median household actually earns. It's not 10 times more like we were back in 2005-06 time frame, but it's getting there. Our one saving grace is on the right-hand side is that interest rates have actually been pretty low, and in fact, they went down a bit last year, and that helped to offset some of that price growth. But when we got this big jump in rates in the second quarter up to 4.5%, combined with that 7-8% price growth, what you can see is that instead of comparing the price to incomes, on the right-hand side, we're comparing that median home's payment after accounting for interest rates and taxes and comparing that to incomes. Again, it hasn't been in crisis territory, but as interest rates go up, you see how much of a toll that takes on that median payment and what that does to interest rates. And so again, I think to Hiram's earlier question about do we see home prices tanking in the near future, I don't see that, A, because list prices are still positive, and B, if you go back to 2005-06 timeframe, that payment on the median priced home was consuming 90% of the median household's income. Now it's only about 60. So yes, that's pretty high, but it's nowhere near eating up their entire paycheck. And so, we're slightly above our historic levels of unaffordability, really. But I think that, there's no doubt that as this supply crisis continues to persist, it erodes affordability and makes our housing market more vulnerable to an economic shock. And of course, the bread and butter is why it matters for home ownership. So if you look at the home ownership rate, we were up at about 60% home ownership and declined to the low 50s by the end of 2016. But look at the US, which is this green line. So since about mid 2016, we've been seeing pretty consistent and modest improvements in home ownership nationwide. And unfortunately, in California, we're either been flat or actually in the most recent data for the second quarter, home ownership actually started to go back down, right? And so this does suggest that there's something unique about California where, the rest of the nation is seeing a rebound in home ownership. That hasn't happened here in California yet. And so, again, that's a problem for us as realtors, not enough transactions, but it's going to be a deeper economic problem as we move forward. So with all that being said, this is what our forecast looks like. We have home sales going down by about 1.5% or so this year. That's actually a little bit less than where we are through the first 8 months. So there's potential that we might revise this forecast for transactions a bit lower still. We have home prices going up by 8%, which is where they were going through the first 6 months of the year. But we might actually tamp this down in light of what we've seen happen on the side of list prices, where list price growth has dropped into the 3.5% range. The Housing Affordability Index, we think will end the year, this is an annual figure, at about 27%. We were at 26% in the second quarter. But look at next year, right into 2019, we have that dropping to just 24%, and we have us ending up the year with an annual average interest rate of about 5.2%. So, still going to be more volume, but unfortunately, we do see the market shifting, and we want to be as clear about that as humanly possible. So, if you put it all together, the economy is still going strong. There's still plenty of demand for housing out there, just not as much as we have seen. And I think that's both due to the erosion of affordability and some trepidation on the part of buyers, but prices are still going up. And with these new listings, I think that at least over the short run, that's a real opportunity for you guys to get out there and carve out some new clients, carve out that market share. And with prices continuing to go up, it means more volume. Prices or homes are still moving pretty quick, right? I showed you that 20 days for the median time on market, but that might actually be a good thing for your sellers, that they're still going to expect to sell them quickly, even if it's not quite as fast as what it was earlier this year. And I also think that rising rates are going to be a good motivator to get some of your buyers, off the fence. If I had buyers who were sitting on the fence and saying, I don't know if I should wait or not, well, the one thing we're pretty sure about is that rates will continue to go up. And so I would show them that median payment and what happens to it at higher levels of interest rates to get that same exact home, right? That might be enough to scare them into getting off the fence. And of course, with the market not being as competitive with these extra listings, that gives them less bidding wars to fight against, and buyers can actually start to think about doing some negotiation. That being said, I'm going to take this last opportunity to be the wet blanket and say we are seeing that sign of a market shift, actually myriad signs of a market shift. The sales are weak. The inventory that has come online isn't being snapped up. We're seeing some discounting on the side of active listings. And when you look at listing prices, they're actually growing much slower than closed sale prices. And of course, even though my dad would again kill for today's interest rates, as they go up to 4.5, 5, 5.5, it does take a big bite out of people's pocketbooks. And so we're still forecasting growth, as you saw, for this year. And I do think that this is signs of a market shift rather than a market implosion, right? Think of a foot coming off the accelerator rather than a foot slamming on the brakes. So don't get too scared by the scare tactics you see in the papers, but also be conscious that you're going to have to get out there and hustle and really make it happen to carve out your market share. It's still largely a market share game. And so with that, I will shamelessly self-promote our Housing Matters podcast, which I hope you guys will tune into on iTunes or SoundCloud or wherever you guys get your podcasts. And remind you that, again, if you could stick around and fill out that post-webinar survey, we'd really love to have your feedback and find out what we can improve on. And with that, I will say thank you guys so much for joining. And we'll see you next time.